How to read candlestick and volume charts on Binance. In your trading system, come to this icon here and then choose candles. You can also choose bars and hollow candles. It's exactly the same data, just drawn in a slightly different way. So how do candlesticks and volume charts actually help us trade? Well, what they do is show us areas of supply and demand and where the buyers and sellers are actually battling out at certain prices. So if we know that, then we can actually look for some trends in the price action to show us what exactly is happening with the price and where is it going in the future. We can use different timescales for that, both short-term and long-term, and that gives us different data points that we can use with our trading. And then what we're really trying to do with this is to determine who's winning and where is the price going to go. Are more buyers coming in, and so they're going to be pushing the price up, or are sellers winning over time, therefore the price goes down? So that's what it can help us with to try and determine which way the price is going and some trends that may occur within the price action. So what exactly does a candlestick show us and how are they drawn on the chart? Well, each individual candle is a period in time and we can choose any period in time, 1 minute or 1 year. So each individual candlestick is a period in time and it is drawn on the chart depending on whatever time frame that you choose. At the start of a time period, let's call it 12 p.m., you get obviously the first piece of data drawn, which is the opening price. So you draw that with this line, and that is the open price for this time that we've chosen. Within that time frame then, if we're choosing between 12 and 1, there has to be 4 different prices, which is the open price, the low price. So within that time frame, what is the lowest price that is traded? You also have a high price within that time frame. So the open, low, high, and then you have the close. So there are 4 pieces of data. The price opens, it has a high and a low within that time frame, and then wherever the time frame finishes, which is 1 p.m., that's the close price. Now the open price was below the close price. So we opened at 10,000 and we finish at 11,000. Well, that is a green move, an up move within that time frame, right? The price actually moved up within that time frame. Therefore, we color that in green. Then the next time frame actually starts. So this is 1 p.m. to 2 p.m. We're looking at an hour candlestick. We have the open price, which is usually exactly the same as the previous because obviously it's a second in between them. Then we have a high price. We also have a low price and we have a close price for that period. The close is below the open in this case. That means during this time frame, the price actually moved down between the open and the close. Therefore, we color that in red. And that just goes on. And eventually you have an entire chart of these time frames, and each of these show us exactly what happened within that time frame. When looking at candles, what time frame should we choose? Well, this comes down to what type of trader that you are. If you're trading short term, then very high time frame candles, like yearly candles, aren't going to be much use to you because they move too slowly. So if you trade very short term, like day trading, or maybe you want a position open for a few weeks, then you're going to be looking at candlesticks that are maybe 1 hour to 1 day. The problem is the lower time frame that you look, the more muddy and unreliable the data is. The higher time frame that you look at, the more reliable that data is because it's much stronger and it's happening over longer periods in time. So if we look at the chart, I'm currently on the day chart. The day chart is really the starting point for looking at candlesticks, so we know what's happening on a daily basis. But if you're trading over 1 day, then that also isn't going to be much use to you. So you can come down here and choose the lower time frames, maybe the 1 hour. So if we click on 1 hour, things change. We're just going to reset the chart. Now each of these candlesticks is 1 hour in length. And these look very, very volatile. You can see the price moving up and down, but actually the price moves aren't that big because what we can see on the right-hand side is that we're looking at price moves around about $1,000 each side, which isn't a massive move. So the price can look very volatile, but the actual price movements aren't that big. Now, if we go to something like a month chart, So we'll look at this, we can reset the chart. Now we're looking at each of these candlesticks being 1 month. And so this is going to be slow moving, but you can see much more, strength within the trends. So you can see these trends happening like this. And so that shows you how strong the trends are. So if you're looking to trade, you really need to understand, well, what is the time frame of your trade? And also you can use these time frames together to give yourself a better idea of what's happening. So for example, right now, as we're making this video, this is clearly a very strong uptrend. Now there will be green and red candles in this, but if the very long term is telling us that we're in an uptrend right now, maybe that can give us some pointers as to what type of trader we want to be. Do I want to be bearish and negative in this scenario? Probably not. This is an uptrend. So what I want to do potentially is to try and use opportunities to buy if we get some negative candles back to the trend, because as I can see, the longer term trend is definitely an uptrend. I can now go down to the day chart and I can search for candles like this one that are, red and bearish and negative, and potentially use those as opportunities to buy because I see that the longer term trend is positive. There are many different types of chart patterns, and I'll go over some of the most valuable right now. So the first one is a type of hammer. So what I'm really looking at here is reversals in trends that we can try to trade, or at least shows us where the price action really is. So what is a bullish reversal? Well, bearish price action is to the downside. Bullish price action is to the upside. So where can we see a downtrend kind of get reversed and actually move into an uptrend? So you can see bearish price action coming down. But like I said, when you see this type of price action, what we're seeing is a potential area down here where buyers have come in and found a lot of support at the price and pushed it back up again. This is potentially a reversal area where buyers have said, this is our buy price, then we're going to outnumber sellers at this point. As the price moves up, you can see now that we've essentially reversed, right? It's like a V reversal. So yes, sellers were pushing it down, but now the price is moving back up again. And so that shows us a potential reversal in the price action from bearish into bullish. Hence, we know that as a bullish reversal. So we can try and see these on the chart. You can see one right here. So you do have a small downtrend right here. And then you get this pattern where you get sellers forcing it down, buyers forced it back up again and actually made it into a green candle. We then get a couple of, kind of consolidation candles and then a move to the upside, right? So we can very clearly see from price action now and the candlesticks, we have this down move, we have the reversal here. And if that continues, of course, we can try and trade that and that move very nicely to the upside. So that is just a classic reversal pattern that you can see from the candlesticks, but also the price action that it actually makes, right? So you can see that reversal there. Now we can also get this to the downside as well, of course, known as a bearish reversal, where you have price action moving to the upside. Then you can see that here. Buyers pushed up, sellers said, that's our line, pushed the price down into a red candle, and then they've carried on into the next areas. And so that would be a bearish reversal, otherwise known as a shooting star, where you have an uptrend and obviously lots of sellers coming in. So you can see that kind of here as well, right? So the price moves up, and then you can see that. You can see what we know as the wicks, right? So these are the lines, that price action within a time frame. This is fairly bearish price action. You have 1, 2, 3 wicks right here, where buyers within these time frames tried to push it up, got rejected, and then had the down move. And so, that gave you 3 time periods, which on this occasion was 3 days, to try and work out that this was a resistance zone. Sellers were coming in and it forced the price a bit lower. So they are reversals that we can see, either bullish or bearish within the candlesticks and the patterns that it gives us. If you're having trouble identifying some of these patterns on your chart, then go over to TradingView and use the All Patterns indicator. TradingView is free, so I highly recommend it. I'll link them below. There are paid versions where you get slightly more indicators. I use them. I think they're great, but you can use the free version as well. So go to indicators up here and then type in the word patterns. And you should see this one here, which is all candlestick patterns. So this gives us, you can see BE, which is a bearish engulfing, which is red. This, which is a bullish engulfing, and then D, which is doji. A bearish engulfing is one where you have a bearish candlestick that engulfs the previous candlestick. That is a bearish engulfing. That's a bearish pattern because this candlestick has engulfed to the previous one to the downside, and that potentially is a bearish indicator. You have bullish engulfings here where you have a candlestick and then you have a big move to the upside, and that's a bullish engulfing because the price action shows us that the move is very strong and it engulfed to the previous candlestick. You also have dojis where you basically get the open and close price being almost the same, and then within the time frame the price moves up, the price moves down, but eventually buyers and sellers just come to the same price as when the candlestick opened. So bearish engulfings tend to be fairly bearish, bullish engulfings tend to be bullish, and then dojis tend to show us that the price is kind of consolidating. So you can see all of those patterns on the chart by using this indicator. Like I said, low time frame, very noisy data. If you go to higher time frames, it tends to be a little bit more concrete. The problem with candlesticks is that they're very unreliable to trade by themselves, and we're going to be wrecked a lot of times because we see the candlesticks moving up and then something happens in the real world and the candlestick reverses, and so our trade will get wrecked. So what we really want to do with candles is use them in conjunction with volume and how that volume shows us the actual price action of the chart. Price action is very simple. It either moves up, down, or sideways. That's it. So they're the trends that we have: a downtrend, a consolidation or sideways trend, and an uptrend. They're the three traffic lights of the market: down, sideways, or up. So all we're trying to do is use these indicators to show us where is the price action. So this is the Bitcoin chart here, previously in the previous bear market. What I'm doing is adding a moving average. So if we go to technical indicator, you can just type in moving average here. It's this one. And this moving average, you can change it around with the settings. I've got a 200 period. So that's a 200-day moving average, which is fairly long term. So what we'll do is use this to show us the price action. Remember, a moving average is a smoothed out line of the direction of the chart. So we can very clearly see that we're in a downtrend here, right? That's very clear. The moving average is moving down. That means the price action is moving down. But the moving average starts to bottom out, go sideways, and move up. So that's interesting. That shows us that we're not in a downtrend, but we're in a sideways or upwards moving trend at this point. Let's now use the volume indicator. So technical indicators, volume. I've used the volume profile visible range here. So I'll click this on. This just shows us where is the most volume traded at any given price. So this is the volume here. This is the price. It shows us that at this price, this is the most traded volume. Yellow and blue is just buy and sell volume. And this red line is the specific price at which the most volume is traded. So what does it tell me? It tells me that on this time frame that I'm looking at, what we're seeing is downwards price action, right? But right here, this entire move, this entire price action here, there's a lot of volume traded, and the candlesticks are showing me that this is basically a consolidation, right? Because it's not moving up, it's not moving down. The whole thing's moving sideways. You can see that. These are the tops. This is the bottom of that range, right? This is a consolidation. So let's think about what we have here. We have a downtrend that has now stopped. This is not a downtrend. This is a consolidation. We now see on the right-hand side that there is a load of volume trading around this price. So let's think that what that actually means. What are people doing? The price is no longer moving down, and there are many buyers coming in, trading this price, letting it not go down anymore. This tells me that the sellers that were actually in charge and forcing the price down are no longer doing that. Buyers are seemingly coming in and changing this from a downtrend into a consolidation or a sideways move. That tells me that the market has changed. No longer are buyers the biggest traders and sellers the biggest traders, but actually buyers are coming in and changing that. Because buyers are coming in, trading all of this volume at this price, that potentially means that sellers are being outnumbered and eventually may actually move out. And so buyers may actually force the price back up again. So we can see a kind of confluence of all of these indicators. The price action from the candlesticks is no longer moving down. The moving average is showing us that that isn't happening, is actually flattening out, right? And the volume is showing that as well, that all the buyers have come in and traded this price. So the next price action may potentially be to the upside if this continues and buyers keep coming in and feel more confident. So that shows you how you can use candlesticks, volume, and some other technical indicators to try and actually understand what's happening with price action over time. I'll leave a much more in-depth candlesticks trading video down in the description for you, and the Crypto Investor course has all of this in much more professional detail, plus trading strategies and everything you need to know about cryptocurrency. I'll leave that linked at the top of the description as well. I'm James, it's MoneyZG. Cheers for watching, and I'll see you in the next one.